Hi, good week to all. This is Calvin here. Welcome to this week's latest edition of our weekly technical outlook on the major stock indices, where I'll be covering the latest medium term, which is the multi-week trend bias, as well as key levels to watch on the SPX 500, the NASDAQ 100, the Hong Kong 50, the Japan 225, as well as the German 40 index for the week of 7th of Feb to 11th of February 2022. So as we know that today is still the 7th day of the Lunar New Year in the year of the Tiger. So I wish you all good health, full of abundance in the year of this water tiger. So before we start, let's take a look at the disclaimer slides first. Okay, so before we go into the technical analysis of the various major stock indices, let's take a look at the momentum analysis across the group for all the major indices. So what I want to highlight over here is, as usual, is last week performance versus its prior week. That I will actually take the weekly performance of last week minus off the prior 4 week average to actually give us the difference, which actually give us a momentum analysis or the rate of change on the respective indices. So what the highlight over here is that if you recall in the last since January, the start of the year, the US stock market has been hammered pretty badly on the downside. One of the reasons primarily is due to the fear of this Federal Reserve, the U.S. central bank, getting more hawkish. But last week, yeah, last Friday, in fact, one of the key economic indicator where most market watchers are watching will be the non-farm payrolls data, which came in stronger than expected. So that actually kind of cemented the, or confirmed that the more or less that we will start to see a rate hike in the March FOMC meeting. And what's interesting over here is that the Fed the CME Fed Watch tool, which actually give us a probability of what market is currently priced at the moment in terms of interest rate hike, which is the Fed fund rates. So the Fed fund futures, as depicted by the CME Fed fund tool, has increased significantly to calling for bets of two, I would say that 50 basis point hike. The usual case, the Fed will tend to hike hike 25 basis point. So now there's actually an increased odds of the 50 basis point hikes. So I did mention this in my social media post early this morning. So later I'd like to know uh, what is my social media account, CMC social media account, so that you can actually follow me and actually get updated to what's going on in the markets, and more importantly, how does it impact the respective financial markets. All right. So, but what's most important over here is that yes, despite Fed are getting more hawkish, but what is being reflected in the market over here is telling us that, hey, the recent January decline or the January bloodshed seen in the major US indexes seems to start to stabilize in the last 2 weeks. Why do I say so? Because the numbers tell me so. Because let's look at the numbers. Okay, so if numbers over here, last week performance has been all green for the US major stock indices. The worst hit, which was in the prior 3 or 4 weeks, was the NASDAQ 100 and the Russell 2000, which consists of tech stocks as well as small cap growth stocks. These stocks tend to get badly hit when the Fed are overly aggressive. Why? Because these stocks in NASDAQ 100 and Russell 2000 are pretty much dependent on leverage to actually, which is borrowings, to actually drive up their bottom line. But what's interesting over here is that last week performance, they are actually the two outperformer, 1.66 for NASDAQ 100 and the Russell 2000 at 1.72%. So if you take into a difference between the last week performance and their prior 4 week average, all of them are actually starts to show positive numbers in terms of the rate of change, which means that momentum, upside momentum has started to creep back at least from a medium term, which is the multi-week time horizon. So 3.32%, 4.6% for the Nasdaq 100, which is the one of the top performer, 2.15% for the Dow Jones Industrial, and Russell 2000, which is 4.91% top performer. And what's interesting over here is the last year underperformer, which is related to China stock market, which is the Hang Seng Index, the Hang Seng Tech Index, has also been relatively robust in last week, which is a shortened trading week, where Hong Kong is actually closed on Tuesday all the way up to Thursday. Yeah, up to Thursday. Yeah, sorry, pardon me. Up to Wednesday. Yeah, Wednesday. Yeah, pardon me. So they only came back in the later part of the week. All right. So Hang Seng Index, okay, what's important here, they managed to actually post a positive return, which also give us we call it a positive rate of change as well. If we take into account of last week performance, 4.34% of the Hang Seng Tech Index, 5.48%, a stark contrast with prior week performance, and that has given us a positive rate of change by comparing last week performance with its prior 4-week average. So the one that is underperforming will be the German DAX, negative 4.3%, the only indices that we cover that shows negative return. And one of the reasons why is because there is a change of tune in the European Central Bank, ECB. So previously, ECB they are actually one of the less hawkish major central banks if you compare it against the Fed, the Bank of Canada, as well as the Bank of England. So the initial expectation was that there's no rate hike for ECB for the whole of this year, and they only start normalizing interest rate in 2023. But however, based on Lagarde, ECB president, last Thursday press conference after the ECB meeting, so yes, ECB didn't hike any rate, but she opened up the scope for there's a possibility of a rate hike in 2022. Okay, so there's a change of tone. So that sparked a bit of fear in the European stock market. So that's being a barometer of the European stock market actually took the brunt of it and actually shed negative 4.3%, which was the worst performer across the group if based on the major stock indices that we covered. All right. So now let's take a look at the weekly performance of the 11 S&P sectors. So you look at the 11 S&P sectors start to show signs of stabilization as well. In the last 2 weeks, we start to see more rates, means more reds than green. So right now we start to see 11 of the sector are in green. And what's interesting over here is that the previously worst hit one, which is at the bottom of the table, now has starts to rose up to form some stability, which is the information technology, 1.06%. Comms services was not too bad, negative 0.25%, despite Facebook, which is Meta, being a significant member inside the comm services, which actually lose close to negative 20% last week. Right, top performer as usual will be the energy, which is benefiting from a buoyant rising oil prices, which is up close to 5% last week. So all in all, right, what we start to see over here is that we start to see a bit of stabilization on the US stock market and further evidence by the correlate or the relationship between the greed and fear index, which is the VIX, over the S&P. So this chart has been flashing for the last 2 weeks. So I will still highlight why it's very important because previous retreat of the VIX at their key resistance level, which is at now it's at 32. Okay, so previous reaction of the key resistance at the VIX level, which represent relatively extreme fear that give a capitulation of the bears to actually give rise to medium-term bullish reversal in the past. I'll repeat again on 15 June, pardon me, 2020. Then you see again on 30th of October 2020, 29th of January 2021, and most recently 3rd December 2020, 3rd December 2021, and on the 24th of January 2022. That was about 2 weeks ago. There you start to see the SPX starts to shape a swift up move, okay, after hitting the VIX at the 22% level. So now the VIX has started to retreat down. So what we are concerned over here is now if we start to come close to this key support level of 14.2, so this where at least in the medium term, we call it the multi-week, where we may start to see a bit of a pullback in the stock prices of or the price movement of the SPX 500. So until it hit this level 14.2, then we will be much more cautious. We will not be outright bullish in our medium term or the multi-week outlook that I'll be sharing with you all. So till then, the VIX is still trying to retreat down from this 32 level, but hasn't hit that extreme or the key support level at 14.2, which actually depict kind of a relatively extreme greed level where the price action of the S&P may start to do a bearish reversal, at least in the medium term. So we has not seen such occurrence at this moment in time. Right. So now let's quickly jump into the technical chart of the major indices that I highlight to you. So let's kickstart off with the SPX first. So if you recall, right, SPX over here, let's go a bit of a recap on our Q1 outlook. So this is a long-term outlook. So I always do a top-down analysis, those who actually follow me very closely. So the key support, right, or the SPX or the SP 500 will be 4240. This is very key. Why? Because it's actually the barometer of the global stock indices. So if this indices starts to break down, the rest of the world should follow suit as well. All right. So what we could see over here is we start to see bullish reversal candlestick, a hammer, a bullish weekly hammer, and a follow through last week at right at this 4240 key pivotal resistance level. So this is my long-term pivotal resistance level that I set for Q1 outlook this week, this quarter. So what we are saying now is we are now climbing up a wall of worry, which is i.e. Irrational up move based on hope. All right, whereas fundamentals have started to turn weak. So what are the fundamental factors I am watching? Again, go to my social media account, my Twitter account. I actually explained very clearly in my Q1 2022 video, which I actually shared 2 weeks ago. Okay, later I will actually highlight you where to find such video. Okay, it's all in my social Twitter handle. So the risk level, right, we are looking at is 4990, maximum 5170, 400. This is the major risk level to complete the Elliott wave or the fractal analysis approach of a Roman bracket big wave 5. So after this big wave 5 complete, that means i.e we should be seeing the potential end of this long-term circular bullish uptrend since the low of May 2009. That means close to 13 years of uptrend, where we may start to see a potential significant 30 to 40% corrective down move. Okay, that could take us to 3720, a break below 3250. So we may start to see a very challenging year for the global US stock market, which is i.e. the global stock market in this year. Okay, this is after the completion of that potential final up move. All right. So now that's for the longer term picture. That means, i.e., what we're seeing now is that potentially in the shorter term to medium term, the market could still move potentially higher from here. So as a trader, this is where I would I should be taking note of. Yeah, I got to better manage my risk because volatility will be very high. But i.e., if I were to be bearish, I would be a bit cautious. Why? Because it could still move higher from this juncture. All right. So from a shorter term perspective or weekly perspective, let's take a look at the daily chart. Okay, the daily chart to tell us what is it doing. So the daily chart, right, what's positive on the daily chart is that last week performance has started to recapture the 200-day moving average after a breakdown below it. Where if you start to see most financial media starts to paint a very bearish picture on the SPX. Why? Because they look at the 200-day moving average because it's easy to explain to audience that hey, 200-day moving average is once break, there will be a high chance of the market start to go down deeper. But it may not be true because we got to look at other aspects of the market to have us decipher the proper trend analysis of the SPX 500. So what you could see over here, very interesting, is that the 4240 key long-term pivotal support holds. We cannot turn outright bearish yet. In fact, there could be a move that I mentioned in my earlier video that the market could actually rally from there, which indeed it did. All right, it did in the last 2 weeks, and it surpass or reintegrate back above the 200-day moving average, which is now acting as a support around this 4423 level. Okay, 4423 level. And your RSI, the daily RSI has also started to turn up from the oversold region. And right now, also trying to inch upward above the 50% neutrality level. So all in all, what we could see over here is momentum, at least on the short to medium term, at least on the medium term, has starts to show signs of positiveness. That means, i.e., given that potential sign of positiveness, we could still see a further potential move up to complete this wall of worrying climb or the wave of irrationality and hope, right? Now, how about on the shorter term for this week, the strategy for this week? So for the strategy of this week, right, if you recall last week, we have a resistance level to watch or a target at 45.90, which the price level of the SPX almost reached that level. So last week, it actually rallied as expected and printed a high of 4594. Pardon me. Yeah, 4594, which actually it hit the 4590 level. Give or take. Okay, so right now, where it actually pull back over here is actually, if I do the pullback, it's actually retrace close to 50% of this up move. If I do the retracement, taking from the low of 27th of Jan all the way up to last week high, which is 50%. 50% retracement. So what we see over here is that this will be my intermediate support 4427, which is also the 200-day moving average. So because given that volatility will be pretty high in the short term, as what you see in the last 2 weeks of movement, where key component stock can actually drop 20%, and which is Facebook, and another key component stock Google can actually raise close to 20% or 15%, which is Amazon. So we do not want to tighten the week for this week key medium term pivotal support to too tight at 4427. In fact, I use 427 as an intermediate support, but the key support for this week will be 4240, which is the long term pivotal support. So as long as this 4240 holds, we could still be in a bullish mode over here. So what I'm expecting over here is a completion of this medium term Elliott wave, impulsive wave one, which is one slash. So if I do the fifth wave target, taking from the low of this bracket 4, which is 25th of Jan, which is it actually coincide with the 0.618, which is at 4675, which I defined last week as my maximum resistant level. So if I'll do the extension from the low of 25th of Jan, project it to last week high, and project it to this pullback low of last week of 4th of February, okay, you see 0.618 right exactly at the 4675. And also what's 4675? Graphically, this swing high area of 17th of Jan before this last steep decline occurred. Okay, and also if I do the retracement, you see the importance of this conference level at 4th of Jan 2020, all-time high all the way down to the low of 25th of Jan, it gives you 76.4%. So this is actually affect a significant level based on the Elliott wave and fractal analysis approach, as well as the we call it a confluence of elements that is pinpointing at 4675, means i.e. there's a high chance that it may hit this level, all right, in terms of the directional bias which we have in terms of bullish over here. So still maintain the bullish bias as long as 4240 long-term pivotal support holds. Then we are looking for another march up potentially to 4590. Then thereafter followed by the key resistance that I set for this week at 4675. So however, if we have a weekly close below 4240, then all bets are off. Then we will start to see a potential kickstart of this major corrective phase, which can last multi-month. But in first step, we are going down towards the support at 40.35. Right now, what's up for the NASDAQ 100? So if you look at the NASDAQ 100 over here, the key long-term pivotal support, which is at 13,900, which I highlighted over here. All right. So now on the as usual, it didn't break the 13,900, so we cannot validate a major corrective phase to kickstart yet. So we could still be in the midst of this final wave of irrationality and hope to complete this Roman big wave 5, okay, which is the end of potential end of the 13-year circular bullish uptrend long term from the low of March 2009. All right, so the risk level is at this 17,590 slash 18,150. Right. So now on the daily chart, it's in terms of the movement here, it's fair slightly not we call it technical in terms of technically. It still hasn't reintegrate above the 200-day moving average. Whereas if you look at the SPX I highlighted earlier on, it's really moved up above the 200-day moving average. So this kind of lag behind from a technical perspective. But what I could see is the RSI also starts to turn, has really exit from the oversold level and now attempt to turn up to actually goes above the 50% level. So once it hit above the 50% level, it could mean that a more stabilization of or an increase in the odds of higher prices to move up, and also kind of a at least a revival of a medium-term upside momentum. And what's interesting over here is that we have a resistance that I set for last week at 15,540. Why is this level important? Because it was the former swing low area of 3rd of December and 17th December that held the previous price movement. Then after a break below it, it actually unleashed this last steep move up, this last steep down move to actually test that long-term pivotal support at 13,900. So definitely this is a key psychological level that the bulls must break above or reintegrate above to actually have a more increase the probability of a recovery from here. So we are taking things one step at a time. So this is daily chart. So what we have on the weekly over here is weekly chart over here is that last week I did a quick update on the video to watch this 14,520 after that big Facebook after trading hours close to about 25% decline. Everybody is being panicky. Would that be the end of or the kickstart of a major corrective move? But I did highlight that we can't validate it. Why? Because we are still holding above key support level, and the short-term key support level was 14,520, which after that on Thursday, the price actually tested and staged a bounce off it from here. So 14,520 is indeed a key short-term support level, always an intermediate support. But given that the volatility is very high, I do not want to squeeze 1450 as my weekly support. So I'll still use 13,900 as my weekly support, which is the long-term pivotal support. All right. So 14,520 is my my intermediate support that I have for this week. So what I'm going to do over here is still no change. I'm still looking to play up towards 15,540 maximum, which is this former swing low area turns into a pullback resistance for the NASDAQ 100. So if you recall over here is that this move here could be the medium term. Okay, let me remove this instead of one. So what you could see here is 1, 2, 3, 4, 5 of one slash. So this is a medium, a wave one, impulsive wave one of a medium term uptrending phase that is potentially still unfolding in NASDAQ 100. All right. So the RSI also, for RSI is also pretty positive after a test on this former resistance now turns into a pullback support level. All right, which indicate to us that short-term momentum on the upside has starts to creep back into the NASDAQ 100. And what's interesting is that the fifth wave target, the 0.618, 76.4. So if we do the Fibo extension, taking from the low of here of 25th Jan, project it to the high of 2nd Jan and last week low, 1, 2, 3, 4, 5, the fifth wave target of one slash, which is the medium term impulsive wave one, the terminal, the ending part of impulsive wave one is at 0.618, which is 15,340, and the 0.764, which confluence with the graphical 15,540. So definitely this is a key resistance level in the medium term that we should be watching for this week. That means, i.e., there is a potential chance that the index gradually drift upwards to this level, given the confluence of elements that is pointing at this resistance zone, based on the Elliott wave approach, which is the factor analysis approach, and based on graphical analysis, and also based on the momentum analysis, both on the daily RSI and the 4-hour RSI. All right. So, however, if we have a weekly close below 13,900, then all bets are off for the bullish buyers. Then we will start to open up scope for the to kickstart a potential multi-month corrective decline phase. So in the first step, it may start to see a decline to test the next support at 12,970 first. All right. So now what we have next for Hong Kong. So recall that Hong Kong 50 last week we turned neutral. Why? Because of a shorter trading week. But right now it really starts to inch upwards and clear above last week upper neutrality level at 24,450. So what we're going to do over here is we are turning bullish for this week, given the potential recovery or potential I would say resurgence of short-term upside momentum, given that the 4-hour RSI starts to now clear above the 50% neutrality level, and it has yet go into the extreme overbought level. Okay, so this is the extreme overbought level. If we take care of the past price action, these three picks over here, right, where price action previously reacted, over here as well, and over here price action reacted after hitting this extreme overbought level at 77%. So the RSI hasn't hit that level yet. So what it could imply that short-term momentum are still positive. So I'm using this gap up here, last week gap up, which is the 4th of Feb, when the Hong Kong market starts to reopen from the Chinese New Year break, 24,000 as the intermediate support. So the swing low here, 23,380, will be my key medium-term pivotal support that I have for this week. So what's 23,000? It's very clear this is a graphical support level. Previously range former swing high broken, turned into a pullback support. And also, if I were to draw the fib retracement taken from the low of 20th of December all the way up, it gives you 76.4%. Okay, so pretty key level as well. So what we could see here is in the first step, it could test this 25,200. So what 25,200 is actually this descending trend line resistance that kept previous rallies since the high of 11th of August 2021. All right, over here. So a break above this level could take us up to this major resistance of 25,870, 26,220. So this major resistance, right, graphically, right, what's this level? Is actually this expand kind of a expanding wedge range upper boundary resistance that is in place since the 52-week high of 18th of Feb 2021. Okay, so this is pretty key graphically, and also this swing high area of 27 October 2021. And if I do the Fibo and Elliott wave perspective, is the one-time projection of the last move up from 20th of December to the high of 20th of January. So it's also pretty significant in terms of the Elliott wave. One time project down to the low. You see, it's the one-time movement from here. So definitely this is the key resistance to watch for this week. So definitely the first one will be 25,200. So a break above this level should take us up to the significant resistance zone of 25,860 slash 26,220, as long as 23,380 key medium-term pivotal support holds. All right. So if we have a 4-hour close below 23,380, then all bets are off. We could start to see a retest again, the long-term pivotal support at 23,000 maximum slash, which is the excess, the low of 20th of December, which is at 22660. Okay, so now moving on, we'll be covering the next Asia indices, which is the Nikkei 225 or the Japan 225, we call it in our platform. Okay, so if you look at the Japan 225, right, it's kind of also stuck inside a range. So definitely this is the key long-term key support. Okay, let's go to the weekly chart again. Okay, so this is the weekly chart. So what I have for the quarterly outlook, right, in my Q122 outlook was a neutrality stance between this major swing high of February 2021 and September 2021. This is close to about 13-year higher for the Nikkei 225 at 30,760. 30,716, and the range support at 26,880. Okay, there's a slight uh, weekly weekly tail, but it actually started to do a reversal last week. So what we could see over here, this could be a potential, it's still a potential impending double top. All right, so what it means that over here is that yes, even though it can stage a bounce, it's still within these two big levels, 30,716 and 26,880 for my quarterly outlook. All right, over here. Then that's why for the daily, right, if you look at the daily situation over here, is that there's also another resistance level before hitting 30,716, which is 26,090, which is the pullback support level, former pullback support from 20th August 21 low, now turns into a resistance. Above this level, you could see this descending trend line that I draw from the 14th of September that has prevented previous rally from breaking up, now acting as a resistance at 28,220. So we see a bunch of medium-term resistance level at this level before even hitting 30,716. So if we will have the bullish bias, which we did last week, at most, we go up to 27,900, maximum 28,820 first in the first step. Okay, so what we could see over here is price has starts to move, has started to bounce accordingly when the RSI start to went below, hit the oversold level. Okay, on this 27th of January. Okay, it start to shape a bounce as well. So a bit of we call it oversold condition where technically it's trying to actually shape a kind of tactical rebound from here. So with that in mind, we could actually play a tactical rebound from a medium term perspective, which is if you look at the 4-hour RSI, 4 RSI is kind of positive in their reading. Last week it pulled back, but this pullback is stored at this former resistance. Now it's turned into a pullback support, and the RSI also attempting to hold at the 50% neutrality level, which indicate to us that at least in the short term, upside momentum seems to be reviving. Okay, so what we could see over here is we still maintain that bullish bias for the tactical rebound, holding above this key medium-term pivotal support that we set for last week, 26,150. Intermediate support will be last week low at 26,950. Okay, so as long as this 26,150 hold for this week, we could still see a potential up move to actually retest this resistance at 27,900 slash 28,110, and above this level could take us up towards 28,820. All right, so what's this level? So if I were to draw the Fibo extension or Fibo retracement, pardon me, it's the 61.8%. Okay, 61.8%, which is 28,110. So in the first step, watch this first resistance first. Above it, it could take us up towards 28,820. So given that this 26,150, right, is actually this low over this swing low over here, which is confluence with this major uh, range support that I have that I set for this week, set for this quarter, pardon me, this quarter. So I will need to have at least a weekly close below 26,150, because this is a longer term level that I highlighted on the weekly chart, before I could validate a down move to the next support in first step at 25,250 slash 25,200. So what's this level, right? This level is in fact, all right, if I were to do a Fibo extension, taking from the high of 25th of Sep to low of 6th of October, project it to the high of 16th November. You see this is one time is here, this 1.236% Fibo expansion. All right, so still maintaining that tactical rebound as long as 26,150 pivotal support holds for the Japan 225. So now, what's next? For the last one will be the German DAX or the German 40. So the German 40 also trading in a range. So it's very similar to what we see in the Japan 225. Since its all-time high on 17th of November, tested it again this year on 5th of Jan, but can't break above that 16,280 level. Did a retracement and now back to the bottom of the range support, which is now at range support that is in place in 6th of October 21, now acting as a support at 15,080 level. RSI attempting to shape a bounce off from the oversold region. Right now, it's actually below the neutrality level, which indicate to us that its momentum is neither here nor there on a medium-term basis, but it's still holding above the 50,080 support level. Okay, so this 15,080 support level, we also had set that as a key medium-term pivotal support that we have for last week. So what we want to do over here is, as long as this 50,080 holds, we could still see at least a push up towards 15,670 slash 15,735. Okay, and the forward RSI, at least it starts to actually shape a bounce up close to the oversold level. So showing a bit of signs of short-term upside momentum is creeping back into this German 40. So yes, we'll be using that 50,080 key medium-term pivotal support as my key support level that I have for this week. All right. So now if we start to have a break below this 15,080 level, which is a forward close below 15,080 level, then we could start to see it coming down towards this 14,800 major support zone, which is the low of 6th of October, and as well as the low of 30th of April and close to 17th of May 2021. So back to retest this major support level. So with that, if I were to actually recap, across the board, we will start to see a bit of momentum or stability back into the global stock market, especially the worst hit in the last 3 to 4 weeks or in the last month, which is the US stock indices. But bear in mind that most of these indices, in fact, all of these indices are just doing a kind of rally of hope and irrationality. That means we are now in climbing out the wall of worry, which could mean that in the next couple of weeks or 1 or 2 months down the road, we may start to shape uh, the start of a major corrective down move. So until that happens, I'll definitely be highlighting in my, in my webinar, in my weekly video, and most importantly, in my social media account. So do give me a follow, which is my CMC social media account at Kelvin CMC. So you can follow me at this at Kelvin SC Wong. So you're able to see this is my latest quarterly outlook where I share with you all the fundamental drivers that form my baseline view over here. So you click over here, it's a YouTube chat, it's a YouTube video. And I also usually highlight the chart of the week on every Monday morning. So take a look. I highlighted on Aussie dollar bearish bias. Why? Just click it. All the explanation are there. And most importantly, I kickstart every morning with a daily commentary on what happened in the market and what things to watch out for. Okay, so again, do give me a follow to keep up to date what's going on in the market. to give you a better perspective on trading the financial markets. All right. So with that, thank you very much, and I see you again in my next video.